What 30 years in the market taught me. Narrated as an older investor speaking directly to you. Sit down. Let me tell you something most people only learn after they've paid for it. I've been in the markets for over 30 years. I've traded through crashes, through bubbles, through euphoria, through panic. And if you expect me to tell you that the secret is a strategy, you'll be disappointed. The market doesn't reward cleverness, it rewards temperament. When I was young, I thought success in markets was about being right. I wanted to outsmart price, outanalyze the crowd, predict turning points. And sometimes I did, but prediction never built consistency. Discipline did. And discipline isn't what most people think it is. It's not forcing yourself to follow rules. It's building a character that doesn't break them. That takes time. The first lesson, the market owes you nothing. When you're young in the market, you feel entitled. You studied, you prepared. You saw the setup clearly, so when the trade fails, you feel wronged. You think the market is irrational, manipulated, unfair. Let me be clear, the market is not unfair. It is indifferent. It does not know you exist. It is a living auction between millions of participants, each with their own fears, needs, and objectives. You are not trading against the market. You are participating in it. Once I understood that, I stopped taking losses personally, and when I stopped taking them personally, I stopped reacting emotionally. That was the beginning of stability. The second lesson, protecting capital is a moral responsibility. When you manage your own money, or worse, someone else's money, loss feels heavier. Early in my career, I focused on growth. Later, I focused on survival, and survival is a skill. If you lose 50%, you need 100% just to break even. That math changes how you think. Capital is not chips at a casino, it is opportunity. Every dollar lost unnecessarily is a future opportunity removed. So I built one rule that never changed. No single trade can meaningfully damage me, not financially, not emotionally. If a position size causes you stress, it is too large. If a trade keeps you awake at night, you are overexposed. There is no prize for trading big, there is only consequence. Professionals stay small enough to think clearly, because clarity compounds. The third lesson, emotional stability, is the real edge. Let me tell you something uncomfortable. Most people are too emotionally unstable to trade consistently. They are intelligent, they are capable, but they are reactive. After 3 wins, they increase risk. After 3 losses, they hesitate. That inconsistency destroys mathematical edge. I learned to measure my state before I measured the chart. If I felt frustrated, I reduced size. If I felt euphoric, I reduced size. If I felt the urge to make something happen, I stepped away. Because the market punishes emotional urgency, it rewards calm repetition. Over time, I realized something powerful. My results improved not when my analysis improved, but when my emotional volatility decreased. That's when the equity curve smoothed out. Not because I predicted better, but because I interfered less. The fourth lesson, patience is rare, and that's why it pays. You know what most investors lack? Patience. They want constant movement, constant validation, constant action. But the market doesn't pay for action, it pays for precision. Some of my most profitable years came from doing less, waiting for clear opportunity, passing on mediocre setups, letting others chase noise. Patience feels unproductive, but inactivity is often strategic. You don't need to trade every day. You need to trade when conditions align. That might mean sitting still, and sitting still requires confidence, not in the market, in yourself. The fifth lesson, losses are business expenses. I stopped using the word loss. I started using the word expense. A business pays rent, a business pays salaries, a trader pays drawdowns. It is operational, not emotional. If you treat losses as personal failures, you will trade defensively. Defensive trading leads to hesitation. Hesitation destroys edge. The goal is not to avoid losses, it is to keep them controlled, small, predictable, expected. Once you expect losses, they stop shocking you, and when they stop shocking you, they stop influencing your next decision. That is maturity. The sixth lesson: the market is a psychological mirror. Everything you avoid in life will appear in trading: impatience, pride, need for validation, fear of being wrong. Trading amplifies character. If you lack discipline in small areas of life, you will lack it in markets. If you chase quick rewards elsewhere, you will chase them in trading. You cannot fake stability here. The market exposes you. That's why trading changes people, if they let it. Over the years, I became calmer not just in markets, but in life, because I trained myself to remain steady in uncertainty, and that skill transfers everywhere. The seventh lesson: you don't need to be right. Young traders want accuracy. Old traders want consistency. I stopped caring about being right. I cared about executing correctly. A perfectly executed losing trade is success. A poorly executed winning trade is failure. That mindset shift changed my trajectory because it removed ego from the equation. Ego interferes, execution compounds. Once ego leaves, clarity enters. The eighth lesson: scale only. When you are bored. Here's a rule I learned the hard way: only increase size when trading feels boring. If trading feels exciting, you are too large. If your heart rate changes with every tick, you are too large. If a small pullback makes you anxious, you are too large. Boredom means emotional neutrality. Emotional neutrality means control. Control allows scaling. Scaling without emotional control leads to collapse. Many traders grow fast and implode faster. Longevity is quiet, gradual, measured. The ninth lesson: wealth is built slowly. No one tells you this, but consistent profitability is boring. It lacks drama, it lacks storytelling, it lacks viral excitement, but it builds freedom, year after year, compounding quietly. I stopped looking for extraordinary returns. I looked for steady ones, and steady returns over decades outperform brilliance over months. The market rewards the patient, and patience is rare. That rarity creates opportunity. The final lesson: the real battle is internal. After 30 years, here is what I know. The market is not conquered, it is respected. You do not control it, you adapt to it. You do not force opportunity, you wait for it. And above all, you master yourself. Because once your internal reactions stabilize, external volatility loses power over you, and when volatility loses power over you, you become consistent, not because you are smarter, but because you are steadier. In the end, trading is not about money. Money is the scoreboard. Trading is about decision-making under uncertainty, and if you can remain calm while capital is at risk, if you can follow process without emotional interference, if you can accept losses without identity damage, you will last. And lasting is everything. Because in markets, survival is success. Everything else is noise. Take your time. Stay small enough to think clearly. Stay humble enough to adapt. And stay disciplined enough to repeat what works. The market rewards those who endure. Be one of them. And let me leave you with something deeper. There will come a moment in your journey when you realize the market is not the enemy. Your impulses are. The urge to act when nothing is required. The urge to recover when nothing is broken. The urge to prove when nothing needs proving. These impulses feel powerful, but they are expensive, very expensive. In my early years, I confused activity with progress. If I wasn't in a trade, I felt behind. If I missed a move, I felt inadequate. But markets are not trains you must catch. There will always be another opportunity. Always. The problem is not missing moves. The problem is forcing them. And forced trades are rarely aligned trades. You must learn to sit with the discomfort of doing nothing, because doing nothing is often the most profitable decision available. That is not laziness, that is restraint, and restraint is strength. Over time, you will notice something interesting. The more you slow down, the more selective you become, the clearer everything looks. Noise fades, emotion fades, urgency fades. You begin to see markets structurally instead of emotionally, and that shift changes your trajectory. There is another truth few speak about. Markets test your humility. Just when you feel confident, they remind you that you are small. Just when you feel cautious, they reward patience. You cannot dominate this environment. You can only participate wisely. The traders who survive decades are not aggressive personalities. They are measured personalities. They understand that capital is hard-earned. They understand that reputation, if managing money, is fragile. And they understand that confidence must be grounded in process, not recent results. If you ever feel invincible, reduce size. If you ever feel desperate, step away. Both emotions distort judgment. Maturity in markets is not about eliminating emotion. It is about recognizing it early enough to prevent interference. That awareness takes time. It is built through reflection, through reviewing your mistakes honestly, through accepting responsibility completely. Blame delays growth. Ownership accelerates it. Another thing experience teaches you is this: consistency is fragile. It must be protected, not through perfection, but through routine. Routine stabilizes behavior, pre-market preparation, defined risk parameters, post-trade review. These small rituals build structure. Structure reduces impulsiveness. Impulsiveness destroys performance. In the end, markets reward those who treat trading like a profession, not a hobby, not a thrill, not a shortcut, a profession. And professions demand respect. Respect for risk, respect for capital, respect for uncertainty. If you respect the market, it will not make you rich overnight. But it may allow you to stay long enough to build something meaningful, and that is enough. Remember this: you do not need extraordinary returns. You need sustainable behavior. You do not need to win every trade. You need to avoid catastrophic mistakes. You do not need excitement. You need stability. Because stability compounds, excitement collapses. If you can internalize that, if you can truly accept that slow progress is real progress, then you are already ahead of most participants. The market is not a place to prove yourself. It is a place to express discipline. And discipline, practiced long enough, becomes freedom. So move carefully, think independently, risk modestly, review honestly, and stay in the game. Because in this profession, time is the greatest edge of all. Endure, and let compounding do the heavy lifting. That is how wealth is built: quietly, deliberately, professionally.